In this video, I'm going to talk about how you can save for your down payment on your very first home faster by investing in Canadian dividend stocks. Canadian dividend stocks are essentially large, mature companies that pay you a portion of their regular profits through dividends on a regular basis, and that could be monthly or quarterly. These companies can essentially help you build your wealth over time by providing you with a very steady stream of passive income in the form of dividends. But did you know that you can also use these very same companies to save for your very first home faster and all on a tax-free basis? Well, that's what exactly this video is all about. Thanks to the new First Home Savings Account, or FHSA for short, you can now contribute up to $8,000 a year into this special account and deduct this contribution from your income taxes, just like an RRSP. It does have a lifetime limit as of right now of $40,000, but you can contribute $8,000 per year. And here's the other great part. You can withdraw this money within the next 15 years on a tax-free basis in order to buy your first home. Just like you could with a TFSA. That withdrawal is tax-free. And the great part is you can use this account to invest in anything you'd like. Tech stocks, growth stocks, dividend stocks, ETFs, mutual funds, cash, GICs. You can invest in whatever you'd like. So for this video, I'm going to share with you my top dividend stocks that I'm investing in for my FHSA, or First Home Savings Account. These stocks have a solid track record for paying and increasing the dividends over time, as well as strong potential for growth in the future. So if you already learned how you can save for your first home faster, tax-free, using dividend stocks, this video is for you. So make sure you watch till the very end. And don't forget to hit that like, subscribe, and thanks button on the bottom of this video for more videos like this. Now, you might be thinking that with the crazy home prices that we keep seeing, with prices going up each and every single month, even though the Bank of Canada has raised interest rates numerous times, does it even make sense to go the route of dividend stocks, or should you go all in on growth stocks? Firstly, there is no right or wrong approach when it comes to investing. It's all relative to your personal situations. So for some, it's better to go with dividend stocks. For some, it's better to go with GICs. For some, it's better to go in on growth stocks or tech stocks. Again, it's all relative to your goals and what you're looking to achieve. But for me, I prefer dividend stocks for my first home savings account. And the main reason is that, generally speaking, dividend stocks tend to be more stable and less volatile than, for example, compared to growth stocks. And this helps reduce the risk of losing your money in the event of a market downturn. And don't forget, this money, you're earmarking it for your first home. You're going to use it to purchase your home and use it for down payment. You really don't want to put it into an all-in grow or no-grow kind of situation, because you don't lose that money. You want to be generally available when you actually are in a position to buy your first home. Dividend stocks generally belong to mature and profitable companies, and these companies have a major competitive advantage over their competitors and usually have a loyal customer base. And these stocks can provide you with very real tax benefits if you hold them in a registered account, like the First Home Savings Account, like the RRSP, like the TFSA. And these dividend stocks can really benefit from compounding over time, especially if you are reinvesting those dividends and growing the number of shares you own over that long-term period. Because that income that you're generating from holding on to those dividend stocks, that income is tax-free as long as it stays within that First Home Savings Account. And when you withdraw your money to buy your home, well, guess what? That income that you're withdrawing is also tax-free for your first home. Now, for something like my retirement, then for sure I'm going to use more growth options like ETFs, because I have a much longer time frame and just a different goal in mind. That's what I mean. Personal finance is very personal, and there is no right or wrong approach when it comes to investing. For my First Home Savings Account, I'm going to use a different strategy. For my RRSP, I'm going to use a different strategy. For my TFSA, again, it could be another different strategy because I have different goals I'd like to achieve. In case you don't know what a First Home Savings Account is, except for the fact that you need $8,000 a year that you have to play with, and you can invest a maximum of $40,000, there are many articles and videos out there that give a deep dive into this topic, so you can defer to those resources. But I'm going to give you a quick summary on how a First Home Savings Account works. Essentially, considering the state of Canadian real estate, the government launched a new program to help Canadians save for their very first home. And this program is called the First Home Savings Account, or the FHSA. This is a new registered plan like the RRSP, like the TFSA, in that they're registered and they have special tax treatments, you can use the FHSA to save for your first home on a tax-free basis. The basic requirements to open an FHSA is that you need to be at least 18 years old, have a SIN number, and make sure you note this part down, is that you should not have owned a home where you lived in this year or at any time in the last 4 years. If you meet this criteria, then you generally may be able to open an FHSA. Now, why would you want to open and invest in an FHSA? Well, the first part is that you can invest up to $40,000 on a tax-free basis. That income can grow, and you can withdraw that money if you're using it to buy your first home on a tax-free basis as well. Not to mention, you get 15 years to contribute tax-free. You can carry forward any unused contribution room from the previous year for as long as you have the account. That, plus you can potentially reduce your tax bill and carry forward undeducted contributions indefinitely. You pay no taxes on any investment earnings, plus it's a complement to the Home Buyer's Plan or the HBP. And here's some key numbers that are super important when it comes to knowing and understanding how the FHSA works. First, $8,000. This is your annual tax-deductible contribution room. Think of this like the RSP, where you get a larger tax refund for contributing into the account. $40,000. This is the lifetime contribution limit, meaning the max you can put in your FHSA is $40,000. And if you're contributing $8,000 a year, in 5 years, you'll hit that $40,000. $0. This is how much you'll pay in taxes on earnings within your FHSA. I'm assuming you're using this money for your first home and not for anything else. So that's your first home savings account in a nutshell, and part of the reason why I prefer dividend stocks to use inside the FHSA. That's enough on how the account works and how it relates. Let's actually talk about the actual stocks that I'm using for my FHSA. The first stock you want to consider for your first home savings account is RBC, ticker symbol RY. RBC is one of the largest and most respected banks in Canada, and it has a track record of paying dividends for the last 150 years. Not to mention, it's also one of the largest banks in the world. As a shareholder of RBC, you are definitely in some very good company. So how can you get closer to your dream of owning your very first home by investing in RBC? RBC has a diversified business model that spans across personal and commercial banking, wealth management, insurance, capital markets, and investor and treasury services. This essentially allows RBC to generate consistent and stable earnings from various sources, even during the most challenging economic circumstances. RBC also has a very strong presence in international markets, especially in the US, where it operates as RBC Bank and City National Bank. This gives RBC access to growth opportunities and a whole host of diversification benefits by being heavily invested outside of Canada in the US. RBC has a proven track record of delivering shareholder value through dividends and share buybacks. RBC has increased its dividend every year since 2010 with an average annual growth rate of 7%. RBC currently pays a dividend at a yield around 4.3% based on its current share price. In summary, RBC is a great Canadian dividend stock because it offers you a unique combination of income, growth, stability, and quality. By investing in RBC through your first home savings account, you can benefit from regular dividend payments, a potential for capital appreciation, diversification benefits, and most importantly, a peace of mind. Now, you might be thinking that what's the best platform to use if you're trying to open up your very own first home savings account? Well, for me, I prefer Wealthsimple for my first home savings account. Wealthsimple offers automated investing and robo-advisors, which means you can let the expert handle your portfolio and adjust it according to your risk and goals. It's a great platform that's regulated, secure, which means you can trust them with your money and personal information. All this means that Wealthsimple offers you better investing options than the big banks because you don't have to pay heavy fees for investing your money. I'll leave a link to Wealthsimple in the description of this video below so you can start looking into your first home savings account with Wealthsimple. If you're looking for another great Canadian dividend stock to invest for your down payment, you might want to consider Bell Canada, ticker symbol BCE. Bell Canada is one of the largest telecom providers in Canada. It offers wireless, internet, TV, and home phone services to millions of customers Canada-wide. It also owns media assets such as CTV, Crave, and TSN. And Bell has a long history of paying dividends and just adding value to its shareholders. If you own a cell phone in Canada, Cell phone prices here are not cheap, and it seems like cell phone bill just goes up every single month. There's a new connection fee or another fee or this or that, roaming fees that keep on adding to their prices. Well, guess what? All those fee increases essentially turn into dividends that are used to pay shareholders. There's a real benefit of being a shareholder with Bell Canada because every time they increase the fee for their customers, well, guess what? That fee increase, piece of it, will come to you eventually as part of a dividend payment. And Bell Canada has increased its dividend consecutively for the last 13 years, and currently it pays a quarterly dividend of 96.75 cents per share. That roughly translates into an annual dividend of about $3.87 per share, or a yield of 6.5% at current share prices. Bell Canada's dividend and its dividend growth is supported by strong, stable cash flow generation. It has a large and loyal customer base, and it's diversified so it can withstand any pressures from macroeconomic events. And recently, it's also been investing heavily into its network infrastructure and innovation, which gives it a competitive advantage and allows it to offer high-quality products and services. Bell Canada is a great dividend stock if you're looking to invest for your down payment on your very first home. And by reinvesting your dividends, you can take the power of compounding on your side and help you grow your savings even faster. To me, it's pretty clear when it comes to the Canadian telecom landscape that Bell is a top, attractive, quality dividend stock that can help you achieve your goal of buying your very own home through your first home savings account. So far, I've talked about two very great Canadian dividend stocks to invest in your first home savings account. The third one up is Fortis, ticker symbol FTS. Fortis is one of the largest utility companies in Canada with operations in electricity, gas distribution, generation, and transmission, and they have a long history of delivering value to shareholders and paying dividends. In fact, Fortis has increased its dividend for every year for the last 47 years, making it the longest-running dividend aristocrat in Canada. To me, this clearly shows that Fortis is serious when it comes to delivering rewards to its shareholders in the form of growing dividends. And not only is it focused on delivering value to its shareholders, it also backs that up by growing and making sure it has a stable business that can support dividend growth every single year. It's a defensive stock, meaning it can withstand economic downturns and market volatility. It's a regulated business, meaning it provides stable and predictable cash flows regardless of demand fluctuations. This makes Fortis a safe and resilient investment as part of your down payment fund. You don't have to worry about losing money or missing out on growth opportunities as long as you have Fortis in your portfolio backing you up. Fortis currently has a dividend yield around 4%, which is higher than the TSX average of around 2.8%. This means you can earn more income from Fortis than the broader market. This means that your dividend income will grow over time, protect you against inflation, and increase your purchasing power. This means that your dividend income will keep on growing. It will keep up against inflation and increase your purchasing power. Fortis is a great dividend stock to build your wealth over time and achieve your goals of home ownership faster through the first home savings account. So far, we've talked about three amazing dividend stocks that you can add to your first home savings account and help you save up for your very first home. The fourth one is no different, and it is an absolute rock star when it comes to great Canadian dividend stocks. If you're looking for a reliable and profitable Canadian dividend stock that will help you achieve your goal of home ownership in Canada, then look no further than Brookfield Asset Management, ticker symbol BAM. Let's run through some reasons why this company is an absolute amazing choice for your portfolio to supercharge your savings for that down payment on your first home. Firstly, Brookfield Asset Management is a global leader in alternative asset management. They have over $600 billion in assets under management across real estate, across infrastructure, renewable power, private equity, and credit, and this list just goes on. They have an amazing proven track record of delivering value to their shareholders with an average annual return of 19% over the last 20 years. And they pay an amazing dividend, a quarterly dividend, and has a yield of 4% at the current share price. And not only does it have a strong dividend yield, but that dividend yield has an amazing growth rate as well. They're looking to grow that dividend over the long run. Brookfield Asset Management has a top-notch balance sheet and ample liquidity, which enables it to weather any market volatility and take advantage of attractive investment opportunities. As you can see, Brookfield Asset Management is an amazing dividend stock that can help you achieve your financial goals and help you get closer to your dream of home ownership in Canada. It's just an absolute tank of an investment that covers all spans of the industry, and it's just a growing beast of a dividend stock. I honestly hope this video was helpful and you found it informative in getting you started with your first home savings account. If you can do me a solid favor, hit that like, subscribe, and thanks button, and don't forget to share this video with your family, with your friends who are also interested in getting started with their very own first home savings account. I have exclusive offers for you to check out in the description of this video for stuff that I use on a daily basis. That's it for now, and I'll talk to you in the comments section.